Hello, this is my second marketing lecture on targeting in STP marketing, that is analyzing and targeting markets. Having decided how best to segment the market, the marketing manager is now faced with a series of decisions, namely on how many and which segments to approach. Thereby, three factors should be taken into consideration, namely the size and growth potential of its segment, the structural attractiveness of a segment, and the organization's objectives and resources. The starting point for this involves examining each segment's size and potential for growth. Obviously, the question of what is the right size of a segment will vary greatly from one organization to another. About the question of each segment's structural attractiveness, the marketing manager's primary concern is profitability, of course. It may be the case that a segment is both large and growing, but that because of the intensity of competition, the scope for profit is low. Several models for measuring the segment's structural attractiveness exist, and we will discuss those later on. The first step that one needs to take in evaluating and structuring a segment is a competitive analysis. So as far as competitive analysis is concerned, there's 5 questions that we are interested in, namely, who are our competitors? First of all, focusing on identifying them. Secondly, what are their objectives and strategies? Then we'll take a look at their strengths and weaknesses. And finally, we would like to evaluate their reaction patterns. Now, if you look to the right side of this slide, those are the things that we are going to discuss. First of all, we're going to take a look at the basic conditions of supply and demand. That is a competitive analysis which on the supply side looks at the capacity, at the category, at the location, the technology applied, the attitudes and the policies. On the demand side, the market volume, the revenues, the business mix, the price, capacity usage, and seasonality are of importance. Then we move on, after having carried out the competitive analysis, to evaluate the structure of a segment, so to speak, their structural attractiveness. Thereby, we look at the number of sellers, the degree of their differentiation. We look at entry and mobility barriers, as well as exit and shrinkage barriers. Of course, the cost structure is an important feature, the vertical integration and its global reach. And finally, we want to find out how customers behave and how the industry conducts with regard to pricing behavior, product strategy, communication strategy, and legal tactics. This is an overview, and we now go into deeper water as far as the competitive analysis is concerned. In order to understand and appreciate the competitive analysis, we need to focus on the following aspects of it, namely what I call market vocabulary. You should keep those things in mind in order to understand and recall those technical terms which are important. There's 2 tables that you see of a hypothetical competitive analysis. The first table gives you the market potential and the market volume, and the second table explains the market shares. Let me turn to the first table, where the four competitors are outlined here, A to D. The first thing that we want to look at is the capacity in BN. BN means best nights, and sometimes we also say guest nights. It's the same thing, bed nights or guest nights. So the capacity of our competitors is outlined here. The capacity is calculated by the number of beds times the opening days of the hotels, and this is how those figures and numbers come about. The second column here, or the column next to it, is the published price in euro. The published price in euro can be obtained from price sheets or the website of the hotel, and it outlines the price that those hotels are charging for a bed night, and therefore those published prices constitute a maximum that is charged. In order to arrive at the public price, you can calculate the average of a year. If you multiply the capacity with the published price, you arrive at a yield in euro. This is the maximum of revenue that could be obtained in the respective hotels. The totals are referred to as the market potential. Like as far as capacity is concerned, we have 191,800 bed nights. We have a published price on average over all four competitors of 42 euros, which gives us a market potential in revenues or yield of about 8 million euros. The next columns refer to the market volume, the results that have actually been achieved. And as you can see here, the revenues have been evaluated from competitor A to competitor D. So the total market volume in euro is 3,161,530 euros. The same thing happens as far as the served bed nights are concerned. Here are the figures for the four competitors, and the total market volume is 93,000 euros. We can quickly calculate the occupancy. The occupancy is calculated by dividing the bed nights through the capacity times 100, and this is how those percentages come about. The average occupancy, as far as the market volume is concerned, is 48%. How much of the yield has been preempted, described in the next column, by dividing the revenue through the yield times 100, and we arrive at 41, 42, 39, and 35%, and the total yield in percent is 39%. And finally, we have the price per guest night, that is also bed night, in euro, which is simply calculated if you divide the revenues by the units, and then you arrive at 32, respectively 35, 38, and 33 euros. The total market volume shows us an average price per bed of 34 euros. So this is how the first table comes about. And now if we take a look at the second table, which calculates the market shares, the different concepts of market share should be well known to you, and therefore we're going to start out with a fair market share. The fair market share is the market share that is achieved based on the capacity provided by each competitor. So all we do is we divide, for example, 54,750 by 191,800, and we arrive at 28.55, 22.29, etc. percentages. As you can see, it totals to 100%, so the total capacity of the hotel in percent looks like that. We can do the same thing as far as yield is concerned. The same operation holds true. We divide the competitors' yield through the market potential, and this is how we arrive at those percentages. Again, those percentages all add up to 100%. The fair market share in bed nights and in yield or euros is outlined here. The fair market share describes the market share that should actually be obtained by each of the competitors based on their capacity. Now we're going to look at the actual results, and we see that the bed nights, as outlined here, are again turned into percentages, and the revenues outlined here are turned into percentages here, and that gives you the actual market share. The actual market share, as I said before, is based on the market volume. And now you have some indicators that are quite smart. You can calculate the capacity usage of each of the hotels, either in guest nights or in euros, by dividing the actual market share, for example here in guest nights, through the fair market share. And if you divide, for example, for competitor A, the actual market share of 30.11 through the fair market share of 28.55, you arrive at 1.05. You arrive with the same calculation at 1.06 for competitor B, C, and D. The same thing holds true here for the actual versus fair market share in euros. The general message here is, when you achieve a value here that is above 1, you are doing better than you were expected. When you achieve a value that is below 1, as here, you've done worse than you have expected. An index of 1 indicates that you've actually performed according to your capacity. The final concept in market share is the so-called relative market share. The relative market share describes your competitive position amongst those 4 competitors, and the relative market share is calculating by dividing your market share as compared to your largest competitor. So if we look at the largest competitor, which obviously, as you can see on the actual market share in euros, is competitor A, if we divide the actual market share euro of 28.52 through competitor B, which is the largest competitor of competitor A, we arrive at 1.19. All the other competitors are related to the largest competitor, which is competitor A. So for competitor B, we divide the 24.04 through 28.52. The competitor C, we divide the 23.72 with this figure, and the same thing holds true for competitor D, and therefore those market shares or relative market shares are being calculated, right? So the definitions, just to sum it up for you: the market volume defines the penetrated market, or all consumers which have used the offering in a relevant market and over a given period of time, that is, in our case, for a year. The term also refers to the served market, so you could use market volume or served market in this respect. Then we move on to the market share. When the company sales volume is compared with the market volume, the share that is occupied by the company can be expressed in percentage. And this is exactly the calculations that we carried out here. As outlined and as described, the indexes that we have seen here is basically the fair market share, the actual market share, the actual versus fair market share as a capacity usage indicator, and the relative market share. Once this information has been obtained through a competitive analysis, we have kind of finished that first part of it. We looked at capacity, we can look at category like quality, 1 star to 5 star, we can look at location, we can look at different technologies, non-service hotel, full service hotel, and thereby describe it. The demand is defined as far as the market shares in the market volume figures are outlined. When we would like to look at the structural attractiveness of a market, we apply the 5 forces model of Michael Porter. This slide shows you what it's all about. The hypothesis and the assumption, of Michael Porter is that the higher the rivalry amongst existing firms within the market, the more unattractive that market is. So therefore, looking at the industry competitors gives us a good idea their number and their degree of differentiation on how this rivalry is set. Besides that, 4 other factors and forces apply, namely the potential entrants, the threat of new entrants as outlined here, the bargaining power of buyers and of suppliers. The higher the bargaining power of buyers and suppliers is, the higher the degree of competition within a market. And last but not least, the substitutes that exist, the threat of substitute product or services. Those are, for example, like technology, especially in our days. You can see it yourself. We're having a lecture online and not in class, and that holds true for conference hotels, for convention hotels. As you've been able to see in the past weeks or months, tourism has come to a halt, and things that would have been done in personal meetings are now carried out digitally. Let us go into the various aspects of the market structure in detail. On the right-hand side, we can find a pretty good indicator for the degree of competition within the market. Those are described by the number of sellers, one seller, few sellers, many sellers, and their degree of differentiation from undifferentiated to differentiated. So if we only have one seller in a market, we can speak about a pure monopoly, and no distinction between differentiation has to be made. Monopolies exist either on a base of government regulation, like in Austria, gaming, tobacco, and other aspects have been monopolies controlled by the state, but or secondly, by the pure power of organizations in the market. If you look at Google, who has a market share of 95% in German-speaking countries, we can talk about a monopoly. When we move on here and have few sellers, we now can distinguish between undifferentiated and differentiated markets. And if we have a few sellers, we speak of an oligopoly. An oligopoly could be a pure oligopoly if it's undifferentiated, or it could be a differentiated oligopoly if there's differences between the companies. Pure oligopolies you can find, for example, in the oil industry. There is only a few players who export oil into this world, and therefore they have hooked up into an organization called OPEC with its seat in Vienna, where they fix the prices. This should, however, not be a common thing, but as there is with raw resources or with resources, there's not much difference between the providers. We can speak of a pure oligopoly. We talk about a differentiated oligopoly when the products and the offerings are differentiated. A good example, therefore, is the pharmaceutical industry, because there's so much research involved in developing new pharmaceuticals. The companies in this world have all specialized on certain fields, and therefore they don't compete with each other, but they preempt their own markets, and therefore we can speak about a differentiated oligopoly. If there is many sellers, like with us in tourism, there is two versions of it, namely the pure competition. If everybody offers the same product, like in mass tourism, for example, there is no differentiation between the providers of services, and then we speak about pure competition. Is a rather dangerous aspect of it, but still exists, because the only way that you can survive in a pure competition is with the lowest price. Contrary to it is the monopolistic competition, where there is a lot of opportunity for differentiation. There's many hotels, you will agree with me, here in Vienna, but most of them have a high degree of differentiation by category, 1-star to 5-star, by style, by price, by different options. So each provider in a market finds its own niche. There is many, but the market is in an equilibrium, as you call it, as they all look for their own specific customer. The next structural aspect is the new entrants and exits from a market. Obviously, we distinguish between entry and mobility barriers and exit and shrinkage barriers. The major entry barriers are, for example, high capital requirements. It is really difficult or it is not easy to run a hotel in a city like Vienna, because you first need to build one, which requires some sort of capital. As you know, 90% of the cost in a hotel are fixed costs, so therefore the capital requirements are high. We can talk about economies of scale, that is capacity. Capacity has become a real important aspect in the business, in tourism, simply because those who provide large capacities at least have an advantage at the beginning. Patents and licensing requirements are, of course, a problem. If you don't get a license, if you don't get a patent to operate in a market, then this is considered an entry barrier. The scarcity of locations, for example, central locations are scarce and therefore highly demanded, and also those represent an entry barrier. Raw materials or distributors, for example, or reputational requirements can be also considered an entry and mobility barrier, and thereby we can distinguish between low entry and mobility barriers and high entry and mobility barriers. Similar holds true for exit and shrinkage barriers. If you want to get out of a market, There we can name legal or moral obligations to customers, creditors, and employees that prevent you from exiting a market, government restrictions, low salvage value of assets due to over-specialization, obsolescence, that is, old buildings, buildings that cannot be used for other purposes, lack of alternative opportunities. If you get out of this market, you don't know where to go. A high degree of vertical integration. Vertical integration means that from the purchasing over the production, over the servicing and delivery to the marketing aspect is all in one hand. For example, if you look at McDonald's, that who has their own farms for veggies and beef, they would have their own production facilities. They will have their own distribution facilities as far as their restaurants are concerned. And finally, they do their own marketing. So we talk about McDonald's to be a highly vertically integrated company. And finally, there could also be emotional barriers that prevent from exiting a market. Also here, we have low and high forms of exit and shrinkage barriers. Now let's look at the matrix here. If both are low entry and mobility barriers means it's easy to get into the market, and low exit and shrinkage barriers, it means to get out of the market quite easily. We have low but stable ROIs, whereby ROI stands for return on investment. As such, we can name the example of a travel agent. It doesn't take a high degree of investment or any other entry requirements in order to get into a market. And it's also very easy to get out of the market again because your capital requirements aren't high, and therefore we talk about low but stable ROIs. So an organization like a travel agent can make a lot of money, but it relies to the economies of scale. Small agencies do not survive, large agencies do. If we move to the right-hand side, where the entry barriers is low and the exit and shrinkage barriers are high, we have low and risky return on investments. Now, this is a market that you don't want to be in. When everybody gets into the market, but it's very hard to get out of the market, a lot of organizations will not have an option to make a lot of money because there's a lot of competitors and nobody gets out of the market again. So it's like war. If we come to the next aspect with high entry barriers and low exit barriers, that will kind of be the best structural situation that you could be in, because it ends up in high and stable return on investments. It's very tough to get into the market because of capital requirements, because of scarcity of locations and all other things that I have mentioned. But on the other hand, it's very easy to get out of the market if things don't work. And if both are high, entry and mobility, as well as exit and shrinkage barriers, we talk about high and risky return of investments. There it is vital that you are a first mover that allows you to make enough money until new competitors show up in the market. And the tough thing is it's very hard to get out of it. So therefore, the ROEs are risky. Coming to the bargaining power of suppliers and buyers. This is the chart that outlines the different things. Let me start with the buyers first. Concentration of buyers. There are only few. There are few or many buyers in the industry. Well, if there's many buyers, that's good news, because each organization can turn to a buyer. But if there's only a few buyers, they exercise a lot of bargaining power, because they're the only ones that you can turn to. Differentiation, are the products demanded standardized or not? If your customers, if your buyers pay attention to differentiation, then that is good news. If the buyers do not, if they say a hotel room is a hotel room, then we compete on price. The profitability of buyers, are they forced to be tough? Well, guess what? A lot of people negotiate tough for the best price. And if we are in a buyer's market where the buyers have the say, this appears to be difficult. The degree of forward or backward integration, this is the vertical integration as mentioned with the example of McDonald's. The role of quality of service, if the role of quality of service is high, then that's good news because we can differentiate. If it is not, such as mentioned under differentiation, that's bad news because everybody wants the same standard, and then the differentiation is on price. Switching cost, how easy is it for buyers to find alternative suppliers? If it's easy, then the bargaining power is high. If it's not easy, then the bargaining power is low. If we now turn to the supplier side, if the concentration of suppliers is high, so there's a scarcity of resources, for example, where you have to depend on one provider, then the bargaining power is high. The branding power of suppliers, if you would like to focus on branded goods and services that you receive from suppliers, then their bargaining power is high, otherwise it's low. Profitability of suppliers, same as with the buyers, negotiations get tough if the profitability of suppliers stands at the forefront. The role of quality and service, again here, suppliers that have a high degree of differentiation will provide different prices and different options. If the market is standardized, the bargaining power is low. The degree of forward and backward integration of a supplier is the same thing as outlined with McDonald's. The switching cost, is it easy for suppliers to find new customers, is the same as with the buyers. And the industry is not a key customer group for the supplier. That is, if suppliers do not really focus on tourism but have other fields to deal with, the bargaining power is low. If their concentration is on tourism, it is high. When we've looked at the structural attractiveness, we can turn on to the next step and evaluate the competitor's strengths and weaknesses, which constitute a key element in a competitive analysis. Now, you can actually start out, or you would start out with such an analysis with identifying the success factors. Each industry has different success factors which companies rely on. In our case, there's a hypothetical example for a hotel. For a hotel, of course, there's location quality, there's product quality, service quality, image quality. Of course, the price is a success factor. The experience that the company has in certain segments or fields or markets, and the financial strength. The list could be continued, but let's leave it at those 7 to make the point. The first thing, as I said, is to identify the success factors. And the second step is to evaluate them, whereby there's 2 dimensions of evaluation. The first is the importance. How important are those success factors to your customers? Some of them will be important, like outlined up here, 1, 2, 3, and 5, 1, 2, 3, and 5. Those are the important success factors, and some of them are unimportant to the customer, or let me say less important to the customer, which is finance, which is experience, and which is image quality, for example, in our hypothetical case. You should be doing things that are important to the customer well, and things that are not so important or unimportant to the customer, it doesn't really matter. On the second dimension, we have the performance. How well are those competitors performing compared to you? Are they much worse or are they much better? You could use a scale from 1 to 5 as well, but much worse and much better. And here we see that some of the success factors in our hypothetical hotel are executed much worse, and some of them are executed much better. Now, if you look at this matrix of importance and performance, and that's what the matrix is called, importance performance matrix, you can see that we can now identify clear strengths and weaknesses for our hypothetical hotel. Let's look at the important factors first. As far as the importance is concerned, 1, location quality, and 3, service quality are considered a weakness as we perform much worse than our competitors. Product quality and price are considered a strength in our hotel because we are performing much better. On the unimportant field, we have finance and image quality as well as experience. Finance as being a weakness, and the other 2 are considered a strength. If you look at the 4 sectors of the matrix, you can now clearly say that 1 and 3, which are important and we were performing much worse, is a clear weakness of our hotel, whereby the financial strength of the organization is of less importance, and we also perform worse than our competitors, but it doesn't really matter that much. On the other hand, we have a clear strength identified here with the product quality and the price, where we perform much better than our competitors. So you've defined the clear weaknesses and strengths of our organization here. If we perform on unimportant things much better than our competitors do, we have to ask ourselves clearly whether we aren't wasting our money here. Because instead of focusing on image quality and experience, we should shift those things which are less important to up here, or budgets that are involved here, up here, in order to move our weaknesses into some sort of strength, or at least neutral. Now, the importance performance matrix is a real nice indicator for strength and weaknesses in the industry. Looking at different aspects or success factors of your market, you could actually group competitors along strategic dimensions or success factors into so-called strategic groups. If you look at this slide here, we have chosen the 2 factors, quality and price, and we distinguished between each of them, between low, middle, and high, and therefore this matrix is developed. Now, what we have here is we have 3 hotels defined as a strategic group, where we have a high quality and a high price, and those could be considered the deluxe hotels, for example, right? Now, as far as the middle area is concerned, we have 4 hotels who offer a middle quality and a middle price, which could be considered the first-class hotel group. And finally, we have low quality and low price, which we could consider budget hotels. The competition or the competitive intensity within a strategic group is very high, whereby the competitive intensity between strategic groups is lower or low. So the rivalry amongst competitors is high within strategic groups, as you see those four groups, whereby between those groups the rivalry is a lot less. Now, you might wonder why we have a diagonal spread of the competitors. Well, that is pretty well explained because the strategies of hotels on the long run are set up this way. You should avoid to be caught up in the middle because that doesn't give you a clear positioning. We'll talk about that when we speak about positioning. But I think you can well appreciate that on the long run you cannot have a high quality at a low price, for example, being up here. That can happen for a short period of time when there's low season and you need business or your hotel has just opened up. But on the long run, I think you need to move with high quality to a high price, right? The same holds true for these folks here, the budget hotels. Also, budget hotels provide low quality and sometimes a very high price. Just think of conventions, conferences, trade shows, where there is high demand periods in a location. Then, of course, also low quality hotels move into high price. We call it a rip-off strategy, actually. But again, it is here to generate profits on the short run, but it's never a strategy for the long run. And finally, how can you anticipate the competitors' reaction patterns? Well, that is kind of difficult, but still you could make a good guess. If competitors are nearly identical and they make their living in the same way, then their competitive equilibrium is unstable. There is likely to be a perpetual conflict in industries where competitive ability is at parity. This would describe commodity industry, for example, where sellers have not found any major way to differentiate their cost, as outlined during my explanations of a pure oligopoly, and therefore there's a strong temptation, especially for a competitor with overcapacity, to throw their capacity into the market, and the equilibrium is then unstable. If a single major factor is critical, then competitive equilibrium is also unstable. This would describe industries where cost differentiation opportunities exist through economies of scale, like in tourism. Capacity is a very important success factor. It could also be because of technology and experience curve and so on and so forth. If price is an important factor, or is the single factor in an industry, obviously people would go for price wars in order to gain market share. If multiple factors may be critical factors, then it is possible for each competitor to have some advantage and be differentially attractive to customers. The more the multiple factors that may provide an advantage, the more the number of competitors can coexist. Each competitor has its competitive segment defined by the preference for the factor trade-offs that are being offered. This would describe industries where many opportunities exist for differentiation on quality. The fewer the number of competitive variables that are critical, the fewer the number of competitors. If only one factor is critical, then no more than 2 or 3 competitors are likely to coexist. Conversely, the larger the number of competitive variables, the larger number of competitors, but each is likely to be in a smaller absolute size. And again, here, differentiation makes all the difference. At a ratio of 2 to 1 in market share between any two competitors seem to be the equilibrium point at which it is neither practical nor advantageous for either competitor to increase or decrease share. So if you have a dominating competitor, then you should pay attention to this. On the basis of this, Henderson, who's been the first chairman of a consulting company, proposed 3 rules for dealing with competitors. Be sure that your rival is fully aware of what he can gain if he cooperates and what it will cost him if he does not. Avoid any action which will arouse your competitor's emotions, since it is essential that we behave in a logical and reasonable fashion. And convince your opponent that you are emotionally dedicated to your position and are completely convinced that is reasonable. So in that way, you actually deal with competitors and analyze their reaction patterns. That was it for today, and I look forward to the next lecture.